Well, we're going to get rolling here. We've got a beautiful spring day out, so we don't expect many people to tune in live, but hopefully you can catch this thing tonight or tomorrow morning when you have a chance. Like I said, we like to keep this going on a weekly basis, to keep you up to date on what we think are some important trends going on in the market. The one thing I just want to go through and revisit quick to start off with is last week's acreage report, as that was just really the bullish catalyst in the market. Corn and bean acres below expectations and cause limit up gains. And what we want to do right here with this slide is just take a step back and take a look at the total crop area. And what I've broken this thing down towards the total crop area, CRP, the total area, prevent plant, and then I did a total area plus prevent plant on the bottom. And when you look back the previous 5 or 6 years, you can look at that total area plus prevent plant being a low of 336 million acres in 2020 and a high of 350.9 million acres in 2019. If we look back and just try to gauge on a 5 or 6 year average, that comes into around the 341 to 342 million acre range. Even want to back that off a little bit and look at 17 and 18 and 2016, that tells us that we should have our total area of crops planted plus prevent plant and the 339 to 341 million acres. And right now for 2021 on this most recent planting intentions report, our total is only 332 million acres. So you add in a little bit of prevent plant, we're still coming up a little bit short here. So as we look ahead on what to expect on this acreage report, there's a couple things that stick out to us. One is that in this March of 2021 acreage report, our total planted acres was 3.5 million acres less than March of 20. Okay, so hey, that's way where you can gain 3.5 million acres. If we target, like we just said in the last slide, the total area plus prevent plant of the 339 to 341 million acres, if we think prevent plant can be around 3 million, that means that our total crop area should increase 4 to 6 million acres. Okay, if total crop area increases 4 to 6 million acres, we think reasonably 3 to 5 million should be put onto corn and soybeans. And again, then if we divide that up equally between corn and beans, and we don't have a real strong bias which way it would go towards, we think it's fairly even. That tells us each corn and bean acres are going to be of 1.5 to 2.5 million acres from this March planting intentions report. That puts corn 92.5 to 93.5 million acres, and final bean acres to 89 to 90. Our point being is there's room to find acres in here, especially with a decent spring as we move into the June acreage report. That's just something we need to keep in mind looking a couple of months down the road. Now, if we just look at a quick weekly December corn chart and what this last report does for us, we believe what it does, it puts a good layer of support underneath this market at around $4.50 a bushel until we can get through spring planting, the crops in the ground, and maybe even see some crop ratings. So we think that report, what it did is it gave a good layer of support underneath the market. How much upside potential can we see? Well, $5 is an obvious talking point, and we got near there. To get a sustained move above 540, we think it's going to take some major weather issues. Just like a breakdown below 450 is going to take a great looking crop, it's going to take a major crop issue to get a sustained move above 540. So we're content calling the 5 to 540 area as a resistance zone, and that's where we'd target on making an additional new crop cash sale, and then look at some fence positions on new crop D's corn. When I get over to the bean market, I'm putting good support in here at 1190. Okay, that was a low last week before the report came out. And the other thing is that's also near like that 2016 high. So I think with beans, until we know we've got a few more acres and the crops in the ground, really don't expect a break below the $12 or 1190 area. As for upside potential, I mean, we kind of just work on dollar increments in here for resistance. I mean, I think the first resistance level is going to be $13. I call a good resistance zone 13 to 14. I don't think that this bean market, new crop beans, can go above $14 unless we have a crop issue here, whether if it's delayed planting or a weather issue this summer, okay, $14 is probably going to be pretty tough to get through on new crop November beans. We're using that resistance zone as kind of our targeted area to make another cash sale. And like we've highlighted on previous webinars, is we're going to encourage budgeting dollars for puts on soybeans. We think there's a few interesting things to look at on the wheat market. This first one we want to show you is a KC wheat corn spread. And I know we went back a lot of years here, but we want to show you how historically significant this is when you have KC wheat. And before we came in here to do the webinar, we had May KC wheat and May corn at the exact same price. Okay, that's only happened 2 other times in the last 40 years, in 2012 and in 2013. Okay, we're just not going to spend much time down here. This tells me either that new crop wheat or wheat is too cheap or corn is too high. This is just not going to stay at this level. This spread isn't. This will encourage feed usage. And if we increase global feed usage of wheat, that could bring down the demand for corn. I think another interesting spread to look at here is this is July Chicago wheat compared to July KC wheat. Right now, July Chicago wheat is trading at a 50-cent premium to new crop KC wheat. That's the highest level on that spread in more than 6 months. As you can see, back in February, they were both around the same price. This is another thing that's arguing that KC wheat, not only is it probably too cheap to corn, it's probably a little too cheap when we compare it to Chicago wheat. And the next one we're looking at is this is a weekly Minneapolis wheat versus a Chicago wheat chart going back about the last 10 years. And as you can see right now, we have Minneapolis wheat trading at a discount to Chicago wheat. This doesn't happen very often. And with the dry weather conditions up in the northern plains, if someone wanted to bet on some weather issues, okay, Minneapolis wheat would be the upside leader. Okay, so I think the one thing with this volatility in the market is we really have to, when we look at the wheat market, is really look at it, each individual commodity separate, whether we're looking at KC, Chicago, or Minneapolis wheat. We're going to wrap this thing up in here today. You know, the one thing you got to keep in mind is that the volatility is going to stay high. I mean, we just expect you know, beans to move 10 to 20 cents each day on a range. You know, corn's probably going to be 5 to 10 cents. That's just the way things are going to be. We're going to start trading U.S. weather here. I even think we're a little bit right now trading U.S. weather. Well, this with the report behind us, we got a big supply-demand report out on Friday, but it's not going to be the market mover like what we saw this last week. And we need to remember this report is all old crop. We will not get a new look at the 21-22 marketing year until that May report comes out. When we look at marketing our new crop corn and soybeans, I mean, our goal is to get to 40% cash sold. And we think once we get to that point, you know, you got a dilemma on how to approach it after that. If you push your cash sales much beyond 40% or 50%, you want to budget dollars and buy some calls, okay? Or if you stop at that 40% area on forward contracting, are you at the point here where if you want additional downside coverage on the crop that's not priced, you budget dollars for puts. When I get over to the wheat side of it, if I'm buying in a drought, I really like Minneapolis wheat. I think Chicago wheat right now looks a little bit expensive in here compared to KC and Minneapolis wheat, but KC wheat looks cheap compared to corn. While I'm on wheat, and we really didn't highlight this on this week's webinar, but just from a global perspective, world wheat is getting cheaper. And just today, Russia had the lowest offers for new crop wheat at $235 a metric ton, or $6.40 a bushel. Okay, that is about 30 cents a bushel cheaper than U.S. offers for new crop. So, I mean, this is something we got to remember as a whole when you're looking at wheat, is that it is a global market, okay, and that you're going to have wheat at some point. If it's competing against a feed grain here in the U.S. on corn, it's also going to be competing against feed grains or against corn on the global marketplace. If you have any questions, feel free to type them in here. You know, if we have a little bit of volatility on the report on Friday, we're going to look to do a webinar, you know, at 12:30, just a quick report update. It might be a little bit later, so look for that. If you don't catch it live, we'll do at least a recording for everyone to see. again, any questions or suggestions, feel free to let us know. And thanks for tuning in.